Hey there. This is a question nobody asks out loud. If you knew that waiting just 5 years to start investing would cost you more than $200,000 in future wealth, would you still wait? Most people would say no, but most people are still waiting. Today, I'm going to break down why starting now, not when things settle down or get better, not when the market looks more stable, is one of the most powerful financial decisions you can make. And I'm going to give you the reasons you have never heard before. I am Mo Showman, and this is Wealth Bites, the only YouTube channel and podcast for tech professionals in Australia. Let's get into it. If you're a tech professional in Australia right now, you already know the landscape has shifted. Layoffs that were supposed to be isolated have become a pattern. Restructures that used to happen every few years now happen every few months. And if you're in your 40s, you have probably noticed something about the uncomfortable truth that the job market treats experience differently than it used to. So here's the tension. A lot of people are sitting with, I'm earning well right now, but I don't know how long that lasts. So, do I invest or do I hold on to the cash just in case and put it in my offset account? The tension makes complete sense. But today, I want to show you why that thinking, as logical as it feels, is actually working against you. Because the unconventional truth is this: the more uncertain your income feels in the future, the more urgent it is to build assets today. And let me show you why. The real cost of waiting is actually not what you think. So, everyone heard of compound interest. I know you have heard it 1,000 times. So, I'm not going to give you that lecture again. Instead, I want to talk about something less discussed: the compounding of your missed opportunity. You always know I rely on data and research. That's my preferred way of coming up to this show. There is a study from Vanguard that tracked investors' behavior over 20 years. What they found isn't just that early investors made more money, it is that investors who delayed, even by 3 to 5 years, never fully closed the gap, even when they invested more aggressively later to catch up. Think about what that means. You can't out hustle time. I always tell my kids, time is the only thing you will never get back. A second gone or a minute gone, you will never have it back. So make sure you use your time very wisely. You can definitely earn more, you can invest more, you can take more risks, but the clock doesn't really rewind. Now, the part that most people miss is the cost of waiting isn't just financial, it's actually also psychological. When you delay investing, you also delay building your financial identity. The confidence that comes from watching your money work and grow. The calm situation that comes from knowing you have assets behind you. That stuff that took years to develop, and it can't be fast chat either. The comfort that you can spend money on this car or on this holiday or, supporting your kids. I have clients who came to me at 47 earning 300K a year and still felt financially anxious. Not because they didn't have money, but because they would been putting off the plan for so long. They had lost trust in themselves to make it happen really. And that anxiety is a real cost to move forward. And it started the day they decided to wait. Now, my second part today that I want to talk about is asset prices and really the valuations that people always talk about and, follow research and put it in ChatGPT to understand what's going on in the market. Now, the unconventional stuff I will share with you today about is what actually happens to asset prices over time and why the wait for the dip strategy is always a trap. Let me explain to you. So, the cycle, how it really works is in a strong economy, asset prices go up, rental yields compress, and valuation looks stretched. And people say in the news, it's too expensive. Now, know this: headlines and Instagram ads and Facebook ads, all these things are designed to sell, not to invest. They're not designed for you. They're not designed to lead financial plans or financial decisions. They are really making money when you read these headlines. So people think, oh, the market is too expensive. It's too risky. What's going to happen to the world? Let me tell you, the world never been a peaceful, calm, and cute place to invest. Never. It's always economical problems, political tensions, increasing cost of living, wars here and there, supply tension, anything. There's always a lot of things that will make you feel the world is a bad place. So it's not a bad place. It's just a world full of good things and bad things, and it really make a difference on how you look at it. Now, when people think the market is high, they always talk about this is a bubble, the correction is coming, da da da. The thing is, no one knows the bubble before it happens. People talk about the bubbles after they happen because it's just so easy to say, that was a bubble, but it's so hard to predict. No one is able to predict. Let no one trap you in predicting of the end of the world and the bubbles and the all these sort of things. We know it after it happens. That is always how it works. Now the correction will hit because that is how the market performs. It goes up and down, up and down. That is how the market really works. So when the correction hits, the price drops and the yield improve. Valuations now look attractive. And what do people do? They freeze because now the news is scary. It says, the market is down. It's all in red. It's a bloodbath. So the job market looks uncertain and banks tighten lending. In other words, assets are cheap. And that is exactly when they feel most dangerous to buy. There is a research actually from JP Morgan Asset Management showing that missing just the best 10 trading days in market over a 20 years period can cut your returns almost in half. Half, yes. Those 10 days don't announce themselves to you. They usually happen right after the worst periods when everyone is sitting on the sidelines waiting for things to feel better. Now, let me bring this back to property and everyday investing and everything we're talking about, because most of my clients aren't share traders, they're long term investors. In property, the same principle holds. When interest rate rises, buyers' demand drops and prices soften, and rental yields really improve. For someone with a long term strategy, that's actually a better entry point than peak FOMO. So, FOMO prices is not helpful at this stage. But most people wait until rates drop again, and at which point prices surge and they have missed the window. So the market doesn't really reward people who wait for certainty. It rewards people who act during uncertainty with clear plan and tight guardrails. And that's the difference between our clients and everyone else. It's not that they're bravers. They just have a plan that makes uncertainty feel manageable so they can act anyway. Now let's talk about the invisible wealth leak for tech professionals because I see it very often. So if you are a tech professional in Australia working in Microsoft or AWS or Canva, you have a very strong earning income and you have what I call an invisible wealth leak, and it gets bigger every year you don't address it. And it works like this. You're earning very well, your super is growing, but passively, you don't really know the balance, you haven't checked it, you haven't logged for months, maybe years, and you might have some RSUs or equity vesting. Your tax bill is high and you're paying it and you're moving on. I got this tax bill, and then you pay. You know, nothing is certain except death and taxes. You know that. So life is comfortable enough that the pain of not having a plan isn't really acute. And that's what I always tell my clients. But what's happening underneath is different. Every year without a strategy is a year where the ATO is taking a bigger share than they need to. Every year without a property or diversified portfolio is a year where inflation is quietly eroding your purchasing power. And every year where your super isn't actively optimized is a year of returns you will never get back. Now, a client I worked with recently, a senior engineer in Atlassian, great income, had been paying an extra $23,000 in tax every single year for 4 years. Not because he was doing anything wrong, just because nobody had shown him the legal structures available to him. And his accountant is really a historian. They can't look into the future and build structures to save on tax. That exact $92,000 that should have been building wealth are gone. Not dramatically, just quietly, 1 year, after the other. The earlier you close the leak, the more it matters because it's not just the money you save this year. It's what the money does over the next 10, 15, 20 years if it's invested instead. So, what is the real reason people don't start and how you can beat it? I want to end this by being really honest with you about why people don't start investing earlier. Because it's not what most financial advisors will tell you. It's not lack of information. You're a tech professional and you can know, at your fingertips. You just need a laptop. You can research anything. And it's not really obviously a lack of money. Most of my clients had the income to start years before they did. It is lack of a clear, personalized plan and the belief that they could actually execute it. There is a research from the Financial Planning Association of Australia showing that people who work with financial planners see significantly more confidence about their financial future. Not just because of the financial outcomes, but because of the clarity and accountability the relationship provides. When you don't have a plan, every decision feels like a risk. Should I invest in property or shares? Should I pay down debt or build my portfolio? Should I contribute more to super or invest personally? Without a framework, every question leads to paralysis. Now, when you have a plan in place, those same questions become decisions. They're clear, sequenced, and tailored to your situation. And that's what I've seen transform clients over time. Not some magical investments, not perfect timing, just clarity and the confidence to act because they can see it all. So here's what I want you to do this month. And it's two questions. That's it. Question one: how much tax did you pay last financial year? Not roughly, actually. Pull up your tax returns or your pay slip and find the number for me. For most tech professionals I work with, that number is somewhere between 80 and $300,000 a year. And when they see it written down for the first time, really see it, it lands differently with them. Now, second question for you: do you have a tax minimization plan? Not an accountant who lodges your return, an actual forward strategy designed to legally reduce that number year after year. And please don't think about negative gearing as a tax minimization strategy or even the EV innovated lease car that you want to buy. If your answer is no, or I'm not sure, that is your sign. You need a plan in place. Because the thing is, the money you're overpaying in tax right now is the exact capital you could be using to start investing. You don't necessarily need to earn more. You just need to keep more of what you already earn. And that's where we start with every client. If you want to know how a tax minimization plan would help you and what it could look like for your situation, reach out to me directly. The link is in the description and the first conversation is on me. No pressure, just clarity for you to know your option and to see if and how I could help. Thanks for spending time with me today on Wealth Bites. If this episode made you think differently about timing, about investing, or what waiting is actually costing you, share it with someone in your network who needs to hear it, or maybe your loved one, your partner. And if you haven't already subscribed using the links here, please use them so you don't miss the next episode, where we are going to talk about the different strategies most tech professionals in Australia have never been told about. I am Mo Showman, and this is Wealth Bite, the only podcast and YouTube channel built for tech professionals. Speak soon.